Bless Squad, what's going on with y'all, man? It's your boy, Blessed Applesauce, here to bless y'all with another video here on Blessed to Invest. And today we are here to talk about risk management. This is a very, very critical, important part of your trading career. If you don't know how to do this, your trading career can go from being great to terrible, literally, just by not understanding risk management. But before we get into it, I know this is a highly sought after video, but if you have not watched my previous video on how to identify support and resistance, make sure you go watch that video because we're going to be doing that a lot. Understanding the zones and areas where trends are going to be occurring. So make sure you go watch that video first before getting into that. But if you have watched that video and understand it, let's get into it. This is going to be the ultimate guide on risk management. Okay, so getting into it, when we want to identify our risk, we need to understand where the key players are in the game. That's where our support and resistance come to play. So I'm going to quickly write out our support and resistance. As we can see, we are looking at stock NSIT, and we can see we have a clear support level right here, and we have a clear resistance zone right up here. I'm going to put it just right at the high of day. But as you can see, it's also bounced a lot over here. So this can be another resistance level. And this is a little minor one as well right here. As you can see, a lot of bouncing is taking place right here. So when you are identifying your risk, you want to figure out where the noise is taking place. And you want to put your stop loss as far away as possible from where the noise is taking place. And a stop loss is an automatic order that automatically triggers you out when the stock gets to a certain level. So let's say you own this stock NSIT and you bought it at $100 and it falls and it falls all the way down to $92. You can put an order out there that will automatically trigger you out as soon as it gets to that level. It makes it a lot easier for us as investors because we know exactly how much we're going to lose, and we can identify our risk that way. We can calculate exactly our risk. So you don't lose the whole $100, you may lose $5, which makes it great. So when we are putting a stop loss order, we need to figure out, okay, let's put it away from the noise, as far as possible away from the noise. And on this daily chart, we can see these support and resistance lines that see where the noise is. So we have right here, see a lot of noise going on in between these levels. So we want to put it away from the noise. So if we are looking at a chart, I'm going to change this to a red line where we're going to put our stop loss. Let's say we are looking at the stock here. The best place to put a stop loss would be in this area. Why? We want to put our stop loss right here. I zoomed in a little too much. We want to put our stop loss right here because it's away from all the noise that is taking place in this trade. And just think, if we are looking at this and we bet that this thing is going to go up, if it trends up, it's going to continue to trend this way, in this direction. If it's breaking down and we're wrong, it's going to break these key levels and break down in this direction. This level right here, 1, is away from noise, and 2, it shows us that if it does hit this zone, we know we're wrong on the trade. So this is exactly where we want to place our stop loss based on the current pattern of this chart. Away from resistance, away from support, and away from the noise. So with identifying that, that's where we want to place our stop loss. The next place we want to understand is our risk to reward ratio. This is very important because we want to make sure that we're risking less than what we are able to make. And we want our risk to reward ratio to be at least 2 to 1. This is very important because over a series of trades, so let's say you take 100 trades on the year. If each one is a 2 to 1 ratio and you're winning 50% of your trades, then with a 2 to 1 ratio, you win. Let's make it an even dollar. You win $1. You win $2 if you win, and you lose $1 if you lose. In that perfect scenario, if you won 50 trades, you made $100. 50 times 2. If you lose 50 trades, you lose $50. So on the year, net would be a total of positive $50 because you took a 2-to-1 ratio. So we want to make sure our ratio is at least 2-to-1. We can do 3-to-1. We can do 4-to-1. But when we're taking trades, we want to make sure it is at least 2-to-1, so we have a greater risk to reward on our trades. So to make this a great risk to reward, we want to make sure we can get our entry as close to our stop loss as possible and get it out of the range of danger for our stock. So looking at this stock here, it is trading at $100.61. But away from the noise where our stop loss could be, which would be a great place for our stop loss, would be right here. So based on this, the stop loss we have identified is 11% away. So to make it a 2-to-1 ratio, we would need to have our target at least 22% away, which would make our target way up here off the screen, which is fine. That makes sense. That's okay. If we want a 2-to-1 ratio, we put our stop here, and we want to target a price of all the way up here to 2-to-1. It's going to have to be a lot higher. Or we can wait for a scenario when it gets a lot closer till we see a better risk to reward ratio. So let's say we bought this thing at $92. Well, let's do 93. We bought it at $93. The stop loss would be right here at 3%. And the target would be right here at 60%, which is a 2-to-1 ratio, where this makes a lot more sense because it's more reasonable that the stock would get here, because notice how the stock is bouncing around support and resistance versus support and resistance, support and resistance. So we can see here, if we were to wait for it to bounce again, let's see, we set an alert. Below. We set an alert and wait for it to get to this level. Wait for it where it previously bounced before. We can set an entry here. We have a stop loss that's away from all the noise. And then we have a target that is at least 2-to-1 that is in a reasonable range where the stock is previously topped off at. And as you can see, a lot of times the stock tops off at $103. So this would be perfect. If we are able to get in here at $93, we can put a stop loss here at $90, and our target can be $100, which is a lot more than a 2-to-1 ratio, which will be perfect. So that's what you want to do when analyzing a stock. You don't want to always just pull the trigger on a stock just because, oh, it's going up, oh, it looks good. You want to wait for your key opportunities. You want to create a game plan around it and say, okay, where would the best place? First, you need to say, where would the best place to be to put a stop loss? Where's a safe location where if this stop loss gets triggered, I know I'm wrong in the trade was most likely going to go down. And I know the pattern is invalid what I'm looking at. Second, after you find that, you want to identify where would a great entry point be. It's not always about buying the stock immediately, just saying, hey, I want to buy it just because it's going up on the day. You want to find a sweet spot for you. Where would be the best place to purchase the stock? And a lot of times, as you can see in this scenario, it's going to be a lot of times on the support levels where this thing has previously bounced before. So as you can see, it's bounced here 1, 2, 3, 4 times. So if it gets back down here, it's going to be a great opportunity to buy it again and create, which is number 3, that most next important thing we look for, a quality risk to reward ratio. So down here, it's a 3% down, risking $3 on the trade to make potentially $10 on the trade, which is greater than a 3-to-1 ratio. So that's a perfect ideal way of looking at your risk management and how to identify a great entry on a 2-to-1 ratio. I want to give a couple more examples, and I also want to get into the calculator, how this is actually calculated. So let's get into the calculator first, and then we're going to get into a couple more examples. So Here we go. So here goes the position size calculator. A lot of people, when you're going into this scenario here, you're probably thinking, okay, this is 3% away, so I'm going to throw my whole account into the stock and risk 3% on this trade. No, you don't do that. You're not going to risk 3 to 4% just because you know you need to put the stop loss right here. That's not what you do. In trading, you only want to risk 1 to 2% of your total capital on a given trade. The reason why we want to do this is because we want to lower the risk for us. We're trying to not blow up our accounts. We're trying to keep our accounts safe, and capital preservation is a lot more important than capital gains. A wise mentor told me that you need to learn how to preserve your capital, and the best way to do that is only risk 1 to 2% of your capital per trade. So this is the calculator to show you how to do that. So the scenario we looked at on NSIT, we're going to assume today we have $5,000 in our portfolio. This is the account risk we want to use. I don't recommend going any higher than 2%. But if you do it at your own risk, but I don't recommend it. You didn't hear it from me. So with this scenario, we're going to just put in the numbers here of what our stop loss price is. And we identified this stop loss price $90.04. And the reason why we chose this price is because it's away from all the noise. And if it were to break down to this level, we know our trade is invalid and the pattern is not correct because it did not bounce off of the support level. So this is our exit price. Our entry price we identified would be, we want to buy this thing at our alert around $93.72. So we're going to type that in. We may not perfectly get $93.72, but it's going to be around the general area because we want it to make sure the risk to reward ratio is at least 2 to 1. And our target price is going to be $103. So we're going to type that in there. Let's do 103 even. And the reason why we chose 103 as our target price is because the resistance level, it tends to only push up to $103. So we're giving a reasonable explanation, a reasonable idea of estimate of what this stock is going to do, because generally drops all the way down to 93 and it generally pushes all the way up to 103. So after we type all this information in, voila, the calculator gives us all the information we need. It gives us our risk to reward ratio, which we identified, I spoke to you about earlier. It says the risk to reward ratio is 2.5%, which is good. It's exactly what we need. We need a risk to reward ratio of 2 or greater. The share that we're going to buy, this is the risk on the shares, and this is the estimated profit. So if we're right on this trade, we're going to make $252.17 on using on 27 shares. And as you notice, we did not use the whole account size. The whole account size is right here, our position value. Notice how we're only using $2,546 of our total account, because if we went any bigger, we would be risking more than 2% of our account. 2% of $5,000 is $100. So if we risk greater than that, we're going to be risking too much. We're going to be risking over $100. We only want to risk $100 per trade, because if this trade goes against us and it breaks down to $90, we're only losing $100. But if we win, we're making $250, which is pretty good. You do that trade 100 times, $250 every win, $100 every loss, $150 every other win. If it's a 50% risk to reward ratio, you're doing pretty well. It's a win in my book. So that's how you identify, and that's how you use the position calculator. But I want to get into another example. So let's pull up another chart. And really all this comes down is with practice, just identifying key levels. Like I spoke about in my last video, the support and resistance lines, identifying those, putting your stop loss away from, finding a safe place to put your stop loss away from noise, and then waiting for the entry to come to you so you can get a great risk to reward ratio. So here's Starbucks. First and foremost, we're going to identify our trend lines, our support and resistance levels. So we have a high here at 125. We have a key level here where it bounced off 1, 2, 3 times. We have another level here, bounced off a couple times here, 1, 2, 3, 4. And we have another small level right here. So as we're looking at this, a couple levels stick out to me. The first level is here, and I'm going to highlight it in a different area. So the first level I like here is one place we can potentially put a stop loss, and right here is another level we can potentially put a stop loss. We're trying to put our stop loss away from noise. So away from noise would be here, and away from noise will also be right here. So looking at this chart, let's say we would hypothetically want to wait for this level here for the stock to potentially come down here to give us a decent risk to reward ratio. We can do that, or we can wait for this level here because this is also away from noise. So looking at this with a risk to reward ratio, seeing our stop loss, we want to wait for the stock to drop here. And we're going to put an alert there at or below. Or we want to wait for it to drop here. And the reason why we want to do that is because we want to make sure we have a 2-to-1 risk to reward ratio. Because as you can see, when it gets here, let's say it hypothetically were to get to this level, it has bounced here multiple times. So if it were to break down here, we know this channel where the support and resistance is taking place is now invalid, and it will break down and go below this area. So if we wait for here, where it's previously bounced before, we're betting on history to repeat itself. So let's say we get in at 114 and our stop loss is at 112. Our target price would be based on the next key resistance level of 118. So let's zoom out and put it in our position size calculator and see if the risk to reward ratio looks good. So the target price we said is going to be 118. And for me, I like to put these slightly away from the resistance line, because as you can see, a lot of times it doesn't perfectly get to the next resistance line. Sometimes it almost gets there, but not entirely. So I like to give myself a little room for error just in case it doesn't 100% make it there. So that's why I put 118. Let's do 1750 to be conservative. 1750 to be conservative. Yeah, 775 will be our target. The entry price we said we're looking at, based on the two bounces right here, we're looking at 114.55. And the stop loss we said was going to be at 112.8. Okay, so here we go. We have found our calculation, and as you can see, with that we will be going in with $6,000. So this brings up a couple of things that I want to explain. Sometimes when you are putting this in, it says a position value of $6,000. That means that with your account size, you can put your whole account in without risking more than 2% of your account. So that just means that this stock is not moving over 2% at a time. The distance from your stop loss to the entry is less than 2%, which is fine. That just means you can go on with your whole account size. So as we can see here, if we're looking at the risk to reward ratio, it says 1.8. And that is not a good thing because we want our risk to reward ratio to be at least 2. So there's a couple of things you can do. You can either pass on the trade and find something else, or you can try to edit this, because I know we were a little conservative on the exit. Let's say we do 118. And then let's say we tighten up our stop loss a little bit. Let's say we push it up to 113 and see how the numbers come out. And there we go. We have 2.25. But understand, when we're tightening up your risk and you're loosening up your target, it can create some issues. Just make sure when you're looking at the chart, you're just not making it super tight where, oh, it's going to run into issues, or it may not work exactly how you want it to because you made your risk too tight. So just be aware of that. But in this scenario, 113 is fine for stop loss because it's still away from noise, as you can see. So that's not that bad. And 118 is still fine to give you that nice risk to reward ratio. So that's what we're looking for when identifying our risk. How to manage risk. We're going to look for our stop loss entry first, away from noise, a way where we can get in and we believe it's a good risk to reward ratio for the stock to continue to trend in our direction. We're going to set our alerts and we're going to plan our trade accordingly and set it up so we can make the most amount of money as possible. I want to give you one more example just to wrap it up on a day trade scenario. We're going to use the SPY because that was a great chart this morning to explain what's going on in that scenario. Okay, so here's another example of the SPY this morning. We have a couple of key levels here, a key level here, key level up here, key level up here, the key level right here, level right here, and then throughout the day it kind of just chopped around, bounced around, which is good and bad. I mean, it's good because it's easy to identify your support and resistance levels off of this, and I mean, it's bad because it's not a lot of volume, not as much volume is being traded, but it works. So as you can see, looking at your support and resistance level, you have some levels to play off of where you can take entries, where you can set stop losses at, and it makes it pretty simple. The difference between day trading and long-term trading is, on a day trade scenario, this is all gonna happen very quick. So using a position size calculator really isn't possible. It's more of having an idea of how much you need to put in. So what I do before the trading day even opens, I'll have some a general amount of shares I need to buy before getting in. So let's say on the Starbucks trade we were just looking at, we understand we needed to buy 64 shares of that of Starbucks to meet our goal of having a mass loss of only 100% and to hit our targets correctly. With this, you just have a general idea. Okay, I need about 100 shares, or I need about 50 shares, or I need about 700 shares, or whatever you may need, because when you're day trading, everything is happening so fast. What I recommend, instead of using a calculator, have some numbers on the side, maybe write them down and say, okay, based on this distance, I need X amount of shares. So it really comes down to you just having an understanding of how your position calculator works. You can find these online. They're pretty easy. Just Google position size calculator and it'll show you exactly how to calculate your risk to reward ratio, how many shares you need to buy, your max loss on a day. You can also put your account size in and it will give you that information. But looking at this, let's say I was looking at this yesterday. I see there's support here, so I will put my stop loss down here. boom, I see it bouncing off of this here. Let's say I get in right here, and then we see that my distance, my stop loss needs to be right down here. So my risk to reward ratio, this is a distance of 0.13%. We need to at least make 2 to 1, so that would be 0.26. So our target would be right here. This would where our target would be based on the entry. So let's say we take an entry right here, stop loss right here, target would be right here. And in this scenario, I know this is we've already seen how this moves, but that would work, that would hit my target, and that's how that would work. So it works on all time frames, on a day trade level and on a swing trade level. But that's going to wrap it up for the video. How to identify your stop loss, how to set your risk, and how to manage your risk properly. If you have any questions, let me know down in the comment section down below. What I am going to do, I'm just going to continue to answer y'all questions. And even if y'all have like specific questions, I'm going to try to break them down and maybe like 2-minute videos, like 2-minute quick videos. If y'all want to see that, maybe I can talk about how to manage a trade, how to manage your emotions while a trade is taking place, how to actually set a stop loss in your brokerage platform, stuff like that. So if y'all need that information, let me know down in the comment section down below. But that's going to wrap it up. It's been your boy, Blessed Applesauce. Stay blessed. And I'll see y'all next time on Blessed to Invest.
Just to see tomorrow is a blessing. Stay prayed up is the message. Everything about a nigga blessed. Everything about a nigga blessed.